We have focused in fixing balance sheet problem.
Okay.
Yeah. So even in Korea stock market, there were a lot of various situations. But overall, I can say many of Korean listed companies are under leveraged and have obsolete asset from underinvestment problem. So if we apply optimal financial strategy, they can show better growth narrative and better shareholder returns. That's the starting point.
Welcome to another episode of Alpha Uncovered. Today we have the pleasure of speaking with Mr. Darren Kang, CIO of Life Asset Management, a $1 billion engagement asset manager based out of Korea. Darren began his career in 2007 at Korea Value Asset Management, where he excelled in identifying undervalued equities. He later served as the Chief Investment Officer at Reshaping PSG Asset Management, where he led a very successful activism campaign and delivered some of the highest returns in the Korean mutual fund market. In 2021, Darren co-founded Life Asset Management, where he has rapidly grown to manage almost $1 billion in assets and has recently launched a US-denominated fund offshore. Darren has a reputation for advising some of the most important Korean tribal families in South Korea as they wrestle with corporate succession and inheritance tax strategies. His board also includes the famous chairman Chai-Wan Lee, also known as the Korean Warren Buffett. Darren holds a bachelor's degree in economics and a master's degree in industrial economics from the Seoul National University. Please welcome Mr. Darren Kang. So Darren, it's really good to sit down and chat with you. Just as a quick setup, your firm is now close to roughly $1 billion US and perhaps one of the largest engagement activist investors in Korea. And I'm very, very pleased that we've worked together on building your first offshore US denominated hedge fund, which is really exciting for international investors who want to access your strategy. But maybe for those of us who are meeting you for the first time, maybe you can tell us a little bit about your strategy. In particular, I want to ask about activism in Korea. And maybe to start this off, a lot of investors whom I've spoken to about Korea compare Korean engagement in activism to what's previously happened in Japan. Can you explain what that means?
Comparison between Korea and Japan?
Correct.
Yeah. So in terms of the balance sheet problems, Korea and Japan are sharing similar situation. Both countries are showing low ROE, low margin, and low under-leveraged balance sheet. But the results are same, but causes are very different. In my point of view, the Japanese company's problem is about their inefficient management and the time management. They have no incentive related to stock market price. But in Korea, actually time management have a very high stake on their company, but they have something different problem about their governance system, especially for inheritance. Many Korean companies are family-owned business, and the owning family want to inherit their shares to their children. But at the same time, Korea is imposing world highest inheritance tax, 60%. And this tax will be calculated by market price. So before inheritance, the owning families want to suppress stock market price to reduce their tax burden. That's the starting point of bad corporate governance problem in Korea.
So let me recap this. So what you're saying is that because the inheritance tax is calculated based on the market cap and the market value of the stock, in order to reduce the tax exposure, the families are suppressing the price artificially. And they're doing this, is it because they still control, in most cases, majority of the publicly listed company?
Yeah. So why they are suppressing stock market price, at the same time, their children preparing to pay tax by using bank loan with collateral of inherited shares, or they are doing some business outside of listed companies. So the very frequent situation in Korean stock market is that the listed companies continuously are spinning off their new growth opportunity to private firms. And those private firms often owned by the family's children.
Right. So that means, so if they open up, are these subsidiaries? I guess it'd be side business, and that would kind of siphon or at least redirect a lot of the value into these private companies, right, or private funds. And I guess this isn't great for minority shareholders who are expecting to see those returns through the publicly listed company. So how does the government approach something like this? How do the regulators look at this? Because, minority rights is obviously something that I would imagine investors are very sensitive to. And it's something that some of the offshore investors have been cautious about as well.
Yeah. Last 20 years, the bad corporate governance problem have been very severe. So government already started to fix this problem. So at the end of this year, Korean government currently have a law set for fixed corporate law to make shareholders to have duties about shareholders. It's quite a big change because after fixing these rules from next AGM season, to minority shareholders can make lawsuit against board members about misbehavior. So in terms of real implementation or social pressure, the overall situation is quite quickly changing in Korea. That's the reason why nowadays Korean has booming activist investors in the capital market.
Yeah, I was just looking at your numbers. The onshore fund is averaging, at least up until since inception, it's been averaging a little over 17% annualized. Meanwhile, KOSPI has been suffering, actually. It's been down since your fund started. So you've been tremendously outperforming both the market and generating value for your investors. So congratulations on that, by the way.
Thank you.
When you look at what the government do, you mentioned these rules. Recently, I sat down with the regulators in Korea, and they explained to me this new initiative called Value Up, which is essentially, it sounds like, a voluntary disclosure rule set. Are you referring to the Value Up program, or are there more stronger rules that listed companies need to adhere to? Because if I understand correctly, the Value Up is more of a voluntary disclosure guideline rather than a mandatory, which would then show two things. One is a clear roadmap and expectation on market cap and pricing that the management believes would happen over the next year or so. And then the second part of that is more clear disclosure on the current business operations that would lead to better guidance on sell-side research.
Yeah, as you said, the current government value policy can be definitely tailwind for overall changes of Korean corporate governance and also tailwind for my strategy, engagement activist. But I think that the policy is not the reason of changing, or I believe that the policy is the result of social changes. The overall social pressure is increasing very quickly. So every government in Korea is now keen on the capital market issues. That's the reason why they want to promote value policy. But even without value policy, I see the huge opportunity set in Korean capital market is now arising. I mentioned about inheritance event. The inheritance was the main problem for bad corporate governance problem in Korea, but is now also the opportunity set for investors. After inheritance, before inheritance, as I said, the family owners wanted to suppress the market price. But after inheritance, second generation people have very different mindset because they usually have very big debt burden to pay tax. And for second generation people, they do not want to inherit again because their equity stake already diluted and they want to liquidate their inherited shares to raise money for their family. So it's a matter of timing. When ownership transition from the first generation to second, the dynamic changes very dramatically. So if we find the companies who completed their inheritance process, and then if we can make them to change their mind about their enterprise value, there will be huge opportunity.
So how does that work then? And I guess let's unpack this a couple of ways. So the first question I have is, if they have already extracted, if they've done the first round of inheritance and the remaining assets are relatively diluted, this implies to me that the core founders are they less involved with the company? And is there intention for them to divest from the company entirely? And if so, does that change the prospects or at least the stability of the company, which is something that as an investor, I kind of want to see continuity moving forward? Or is there an opportunity to recreate the management team and perhaps make it more, I guess I'm imagining this, but make it more commercial?
Yeah, from first generation to second generation, their controlling shares doesn't change a lot. For last 20 years, those second generation people were preparing for their inheritance. And they did a lot of misbehavior to protect their equity shares. So from first generation to second generation, their controlling shares are almost same. But those second generation people do not want to inherit again because nowadays doing business in Korea is a hard job. And so the third generation people, the children of second generation, do not work hard like his fathers.
Right.
And so they want to make money, though they do not want to work hard. So those second generation people want to liquidate. This is an economic incentive. And at the same time, the overall social scrutiny and social pressure are increasing very high, like value policy. So those second generation people do not make the economic pool, the economic buffer to prepare inheritance tax like his fathers. So for last 20 years, a lot of top management in Korean listed companies went to jail for their misbehavior to prepare inheritance.
They went to jail for their, they went to jail for,
Yeah, so although they went to jail, but they made success. But for now, as the social scrutiny increased and Korean government are keen on corporate governance problem, so it is almost impossible to do misbehavior again for second generation people. So it's a kind of stick or carrot. There is no carrot for second generation people to do misbehavior, and there is no possibility in terms of overall scrutiny and social pressure level. So these two drivers is now changing the whole landscape of corporate governance in Korea.
so it sounds to me, and I'm thinking about activism and engagement, say in the US, which is often more related to be a more hostile approach to investing, right? Where you take an aggressive approach, fight your way or buy your way into a board seat, and then you pressure or maybe work with other shareholders to drive change within the organization by more aggressive tactics. Now, your strategy is more, when we say engagement, is kind of friendly activism. How does that work and why is this more effective?
In Korea, we need very different approach compared to Japanese and US stock market because, as I said, current second generation people still dominate their companies. So they can easily protect against confrontational activism. I tried a lot of times to conduct confrontational activism in Korea, but I failed all my campaign because the current owning families are so strong. So we need different approach. So that's the reason why we are now using constructive activism like engagement. We have three steps. Firstly, we focused solely on deeply undervalued stocks. In Korea is the world's cheapest stock market in the world, so we can easily find undervalued names. And after that, we sent investment proposal to top management without an investment position or with just toehold investment position. With this first letter, and we wanted to have meetings with top management. After this first meeting, we can identify companies who have good intention about their enterprise value. So over the past 3 years, we held meetings with over 100 companies presenting our ideas for improvement. While more than 50 companies initially declined at first meeting, but the other half were open to collaboration, so allowing us to find real opportunities for growth. So the overall context about corporate governance, which I mentioned just before, is about the opening window for engagement strategy. Because after inheritance, second generation people can be open to outside investors to improve their enterprise value.
So when you say improve enterprise value, I'm thinking very much almost like a private equity approach to public equities. Is that what you mean when you say improving enterprise value? Is it just in investor relations actions, or is there a more thorough restructuring of the business? What would that look like?
Yeah, we have focused in fixing balance sheet problem.
Okay.
Yeah, so even in Korea stock market, there were a lot of various situations, but overall, I can say many of Korean listed companies are under leveraged and have obsolete asset from under investment problem. So if we apply optimal financial strategy, they can show better growth narrative and better shareholder returns. That's the starting point. So like private equity or other activist guys, I don't think I do have a lot of expertise in daily operation or business itself. I'm financial guys. So I want to provide only about financials. In Korea, a lot of companies were in net cash position. So they are using no leverage. That means that they have no connection or relationship with capital market. So for these companies, I can provide capital market access to apply optimal financial leverage to make better growth and better shareholder returns.
Interesting. So you're essentially helping them unlock dormant assets, which, if used correctly, could be very effective working capital and CapEx to help them improve the business. But you don't touch operations. This is purely restructuring of the balance sheet.
Yes, right.
Just to get a sense, one of the case studies that we looked at from your deck before was LS Corp. And we can talk a little bit about that now or not, but LS Corp, in that particular case, you helped them basically double the share price after your engagement. So just by restructuring the balance sheet and unlocking liquidity, you were able to really have a very substantial markup. Is this an expected target return, or is that considered an outlier?
Now we are targeting very discounted companies, more than 50% to Korean market average in terms of price to earning ratio or price to book ratio. So now Korean stock market is trading between 10 to 12 times in terms of PE. So my investment universe consisting with companies with just 5 times or 6 times PE. So we enter in deep discounted situation, and then we want to engage in these companies to re-evaluation event. And then we want to exit at market parity, 10 times or 12 times. So we are now pursuing 2 times multiple. For my engagement strategy, usually it takes 2 years. For first 6 months or 12 months, I have to persuade top management to follow my investment proposal. But after then, we have to wait 6 or 12 months, another 6 or 12 months for them to implement my proposal. So our investment time horizon is 2 years and for 2 times multiple. So LS is very typical case for my engagement strategy.
Right. So let's go back to that case, right? So LS Corp market cap at the time was roughly, this was in 2023 or 2022, I think. Market cap was roughly around 2 to 2.5 billion. This was an electronics manufacturer and a holding company with multiple subsidiaries. So walk me through in this case how you helped the firm restructure. And is this similar where the family was looking to, number one, optimize inheritance returns, and number two, I guess, were they divesting from it or were they staying with the company through the workout?
Overall, I can say the LS case was a very typical case for engaging in family business. But in terms of governance, it had a very special situation. The owning family have 32% of listed shares of LS Holdings, but those family members consisting with 40 members. So for each person, they only have 0.8%.
Wow, okay.
So a lot of shares already were diluted within family members. A lot of stakeholders within family members, they didn't make consensus within family members. That's the main reason why they did some misbehaviors. So in early of 2022, the new chairman, second generation people, got his legend. He wanted to change overall governance system and he wanted to boost overall growth narrative for his business. But other family members, other 40 family members had different thinkings. For last 20 years, these LS holdings continuously did spinning off event. When they found a new business opportunity, they already sold this new opportunity set to private companies or to private equity firms.
Okay.
So because these 40 members usually have no job position inside the holding companies, so they want to exploit business opportunity set from listed companies. This LS company is world number 1 high voltage electric cable provider. They have very good business, but their valuation in terms of price to earning ratio always has been in below 4 times.
Wow.
Because of their continuously doing misbehaviors.
Right.
Yeah.
So 4 times price to earnings. And again, the benchmark at the time was roughly around 8 to 10 times. Is that a fair comment?
Yeah, 10 to 12
10 to 12 times. Wow. So you had a potential upside, maybe 2x over the course of 2 years.
So a lot of Korean investors knew well about those situations, so they didn't want to invest in this company. But the second generation new chairman wanted to change this situation, but other family members were reluctant to these changes. So fixing balance issues, I had to make consensus within family members first before fixing balance sheet. So when we started to engage in these LS companies since early of 2022, for first 9 months, I had to make a lot of meetings with a lot of family members to help them to change their mind. So I showed other legal and social acceptable alternative ways to build their wealth. And I showed them, I made warnings of our family members because the Korean society changed and you cannot do misbehavior like your fathers or your grandfathers. So it took 9 months. So after very lengthy and very long effort, I made some success to make new consensus within family members. So at the end of 2022, they announced to new board members, including outside councils, about their governance problem. And in following year, in early of 2023, they announced new big investment inside this holding company for the first time in the last 20 years. For last 20 years, for new business, they always spawn up new opportunity to private companies and invited outside investors. But in 2023, they announced a new investment in semiconductor materials and battery chemicals. This is very booming business. But they invested all money to new business inside this company. So market surprised about their changes. So even before implementation of their new investment plan, the stock market price reacted to these dramatic changes.
But this doesn't solve the problem of the inheritance tax, right? Because the inheritance tax is still calculated based on the market value of the company. Were they leaving money on the table by injecting new business into the publicly listed company, engrossing the share price, but then they end up paying, 40 to 60% tax?
So LS was the after inheritance situation.
Okay.
The reason why they have a lot of family members, because those owning family members are second generation or third generation people.
So this is after the inheritance had happened already.
After the
Right.
inheritance.
Okay.
So they have 3 siblings at founding partners level. And those 3 brothers have a lot of children. So from second to third generation, and their equity stake diluted to a lot of family members. That's the reason why they have 40 members to own companies. So this is very typical situation in Korean corporate governance. After inheritance, equity stake diluted to a lot of brothers and sisters. And for the last 20 or 30 years, those family members are very friendly with undervalued situation. So even for family members, they have no belief about their enterprise value.
Right.
My companies always have
4 times.
3 price earning ratio.
Right.
So is it possible to have expensive companies for me?
Right.
So that's what I want to persuade them.
Interesting. So the first thing that comes to mind when I hear about this process is how long it takes. I mean, 9 months to get consensus, plus maybe another 9 months to work it out and tap into the capital markets and engage with anchor investors and investor relations. Now that you're running a fund, is it fair to say that your book or your fund is relatively concentrated because of how much effort it takes to do a workout for each position?
Yeah, as I said, usually it takes 2 years to fully implement my strategy. Currently, we are now conducting multiple campaigns. We are the biggest engagement fund in Korea, so we have quite good big team. So we are now conducting more than 3 campaigns simultaneously. So we are now targeting about 10 companies in a year.
Wow. And what's the total universe that you have? I think you mentioned this before, but when you look at KOSPI, the stock market's roughly, I think, 1.9 trillion or so. It's roughly about a little less than half the size of Hong Kong. It's not considered one of the biggest exchanges. So when you look at the opportunity set, how big is that universe for you?
We have 22,500 listed companies in Korea. Among them, we narrowed down our possible target with 3 criteria. One is valuation, they discount the names. And second thing is that about governance, they had to complete their inheritance problems. And third is that their business perspective. We do not want to fix bad companies. I tried a lot, but I failed. So we only invest in good companies with improving corporate governance. So in Korean special situation, we can easily find good companies with cheap valuation with improving corporate governance. So we identified 200 potential names to engage and to invest. With this 200 names, we already contacted more than 100 names. So with this 200 names, those 200 companies have average market cap is $3 billion US dollars. So the total addressable market is $600 billion US dollars. It's pretty big investment. So with this 200 names, we are now targeting multiple campaigns.
So, Darren, I get the sense that it's not just time, but I feel like there's a certain skill set you need to engage with these families because, well, naturally you have a track record. So I think that helps. But I can only imagine being yourself as a founder. How do you hire and train into the team with the type of skill sets? Because it's more than just DCF valuation, right? It's more than just somebody with a CFA. You need a lot of soft skills as well. So how do you pick your team to build a strategy like this?
To build engagement strategy dedicated to hedge fund, in 2021, we made very different team compared to other competitors in Korea. Now we have 35 employees in our company. Among them, most of our investment team members came from various backgrounds in corporate finance field. Actually, including me, we only have 3 active managers to do trade or to do equity research. Other members came from investment banking side, private banking side, or tax consultant or ex-management consulting companies. So I wanted to make very different team, have expertise in corporate finance, not investing, because I have to provide comprehensive solution to address major shareholders issues, not my issues. So firstly, we have to handle the management problem and then make interest alignment to boost enterprise value. So the reason why I can have meetings with top management freely in Korean context, because I have solutions for them. So we do not care about their operation. We do not care about their family matters, but we are now providing investment banking service to major shareholders without any fee because we are aligned with top management. So we are equity stakeholders. So we can provide very precious service for free for management.
Got it. Wow. This is actually really exciting in a way because I guess we're in a way a similar generation. Growing up, in the 80s and 90s, investment banking was the hottest job in the market. But as I came out into the market in the 2000s, the early 1990s and 2000s, investment banking started to give way more to private equity and hedge funds. But what you're doing is you're taking the investment banking model, essentially providing a similar, if not the same service of helping companies with corporate advisory work, but your incentives are through the buy side rather than through the advisory side. And so that's actually, in a way, it's more aligning yourself with the interests of not the client, but the management company or the publicly listed company, rather than being an advisor. Because one of the biggest complaints some of our clients at the time had was, well, you're just an advisor. You're not really incentivized to see or maximize my shareholder value because you get paid a fee. But actually running it as a fund, there's a clear and almost exact alignment in interest as a result of that.
Yeah, that's exactly. My company name is Life Asset Management. The life is initials of long-term investment for everyone. So for everyone means the point that you mentioned. We are acting as an advisor or teacher or consultant for my portfolio companies. So we do not fight with my portfolio companies like conventional activist guys. We are activists, but we want to have my portfolio companies, both for companies itself and both for major shareholders' family. So we are now aligning interest between companies, major shareholders, and our client, and even for me. So with this alignment, we are now making very different situation in Korean stock market.
No, that's brilliant. Do you see, I would imagine you probably don't see that much competition from foreign hedge fund managers. Do you see much competition domestically?
For foreign competition, a lot of activist guys came to Korean stock market for the last 10 years, including alien management or other kind of big guys in US, because they didn't have local relationship and local reference. So they used only confrontational ways to make activist campaign. So the Korean major owning families are so strong in domestic market, so they didn't make any progress in Korean stock market. They all failed. So I think that this engagement business or activist business is very local. So only local managers can do this. In domestic market, after our success, a lot of domestic players copying my pitch deck and they are start to building their own engagement team. But Korean stock market is not big market like US or China. So I can identify only 200 names can be investable. So among those 200 names, we already contacted 100 names and we invested in 50 names. We are now holding 20 position in my portfolio. And we also are conducting 10 campaigns in a year. So I believe that I already preempt this field.
Yep, your early mover advantage,
Yeah,
absolutely. And you've already engaged with most of the addressable market. Is there a reason why, and I guess this is more of a structural question, Darren, right? When I think about your investment model, it feels like it would work well with like a close-ended private equity fund, but your fund structure is an open-ended structure, which means that investors can come at different cycles of the investment lifetime. But at the same time, you don't have a lockup either. So, or it's a relatively short lockup, if at all. So how do you balance that? Because some investors are very short-term in nature. And unless you have a very, very good relationship with the investor who's willing to stay a long time, they can exit at any time. And if they do, could that impact the liquidity of your current fund or could that impact, because some of these companies are mid-sized companies, right? That's one part of the question. And then the second part of the question is, how do you ensure that investors have a similar investment experience, regardless of whether they invest on day 1, day 60, year 1, year 2, year 3, because you have 10 different investments who have varying degrees of varying different phases of their investment life cycle?
Yeah, very good question. Balancing investors' demand for quick returns with a long-term vision of my strategy is always challenging. So for these problems, our investment strategy is unique. Rather than forcing changes to companies, our engagement approach is about supporting companies that want to evolve. So this means we don't need to hold large stakes in our portfolio companies. So I can freely trade shares while still driving meaningful changes. Yeah, so the companies focus less on our ownership percentage and more on the effectiveness of our ideas. So this makes flexibility to trade. This flexibility is a key distinction from traditional activist strategy, allowing us to offer higher liquidity to our clients. That's the reason why we are now providing monthly redemption to our vehicle. Another important aspect is that we conduct multiple engagement campaigns simultaneously, forming a diversified portfolio. As a Korea's first engagement-focused fund, we hold a relatively larger AUM and team domestically, so which enables us to manage over 10 core portfolio companies. Unlike Activism that concentrate only on a few stocks, our approach provides better risk and liquidity management, with returns spread across various holding periods. So diversified portfolios and free to trade, these two strengths help us manage short-term pressure effectively. And
Interesting.
so we can provide very liquidity terms to our client, and we are now making very continuous return.
So Darren, when and just go back tactically, some of the funds that I work with and the managers who look at longer term investment, they have two portions of the book. One is a core long-term holding, and then they have a smaller portion of the book that's tactical, which means that they would trade more actively around. Do you have a similar type of setup, or are you more of a long, like a buy and hold type of strategy where you sit with the company through the cycles, or do you have a part that trades around it?
Typically, we want to hold 20 position. Top 10s usually 60% of our entire portfolio, so that the top 10 are core position. And those top 10 companies we have engaged in last year. So we are now waiting for implementation of our engagement effect. And next 10 positions are companies we are now engaging for this year. So those next 10 position for next year return. So with this composition, we can make continuous track record. But even for top 10 position, we can trade freely. So we can liquidate all our investment position in just 2 months in terms of current liquidity situation in Korean stock
Liquidity.
market. So we are very liquid.
Excellent. So that's fantastic. So you have a rotating book of roughly 10 positions a year. You have roughly under 2 months of liquidity. So if you can meet probably most redemption requirements, which is fantastic. When you look at valuation, you're coming in at a really low base. At the heart of, at least from the valuation perspective, it is a bottom-up approach, it sounds like. Let's talk a little bit about macro. A lot of the fundamental managers over the last 5 years, even including those in the event-driven space, got hit pretty hard because of swings in the market, primarily tied to the US macro story. But your team's managed to generate consistent returns year on year, regardless of the situation. Do you even care about macro? Like, do you even look at what's happening with interest rates? Does that affect how you position or enter into your companies? Or is the discount so significant that it doesn't matter?
While we are not a macro fund, but I believe that analyzing a company's fundamentals without understanding macro factors provides only half the picture, especially in today's interconnected world. So I do macro research while we are seeing investable companies. When we provide some investment banking service to our portfolio companies, they always request to talk about the capital market context, including US or global market context. So we have to study macro event very cautiously.
Got it. Let's talk about risk. So Darren, when you look at it, you have a process that you go through, you have a model, it's proven, you've made a lot of mistakes in the past and you've learned from it, and that's how you've come to this new model that seems to be working really well. What keeps you awake at night? Like, what worries you about the process or about the book that might go wrong, that you keep a very close eye on?
In my strategy, the main problem is that I have no sticks. I have no ways to push my portfolio companies to follow my proposal. So
Only carrot, you mean? No stick in,
yeah,
only carrot, but no sticks. Okay.
yeah. So compared to the other activist guys, we do not push. That's the main pain point for me. So I have to be always cautious about their overall acceptance for my engagement. They can easily change their mind. Yeah. So for example, in 2022, while we are engaging in LS Holdings, we also engaged in SK Holdings. So Korea's #2 conglomerate. We sent investment proposal in early of 2022. They accepted all my proposal at initial meeting. So I excited. Oh, I started to influence Korean big guys. so
Yeah.
I want to make public people to know about my engagement, because at the time we have very small AUM. So we made journalists to write about my engagement with SK Holdings. This made chairman of SK angry. So with some noise, they suddenly cut connection with my engagement strategy. So I had to make loss cut on SK Holdings position. So I have to apply very cautious and sensitive approaches to our portfolio companies to make them continuously follow my engagement process.
That's a great story. And it sounds like you've learned so much, not just from, aggressive, but also friendly engagement. And now it sounds like you have a more prudent approach. The market knows you as, at the time, was one of the youngest CEOs and CIOs in the asset management industry. It sounds like you've had your challenges being the youngest CIO and CEO. What was that like for you when you were engaging with publicly listed companies?
Yeah, I'm still young, although I passed the 30s. So a lot of top management in Korea are in their 60s or 70s. They are quite old people, and they are very sensitive about making discussion with outsiders about their family members' problem or their management decisions. So I need some good reference and good reputation to make this engagement strategy more scalable and more repeatable. So that's the reason why I have another co-founders who have very good reputation in Korean capital market. Actually, including me, my company have 3 co-founders. Current chairman, Mr. Lee, was my ex-boss when I started my career as a portfolio manager. Actually,
He's known as the Warren Buffett of Korea, if I understand correctly. Is that right?
yeah. No, it's right. Actually, Korea just began its mutual fund industry only after 1993. So my chairman, Mr. Lee, was the first portfolio manager in Korea for public equity. So he is one of the most renowned figure in Korean capital market. So by inviting him to my co-founding partners, I can have very good reputation and good network, good access point to top management society in Korea.
So he helps you bridge the older generation with the new style of investment banking,
That's right.
investing.
But because we accumulated our good reference with listed companies for last 3 years, now we are getting inbound calls. So I don't need him anymore. But in early
No,
days,
you need him. You
yeah,
need
yeah,
him.
yeah,
It's
yeah.
just,
Yeah,
he's,
actually, yeah.
yeah,
Definitely I need it.
yeah.
His number one advice. His number one
That's right.
advice for my daily operation and trade. So, but in early days, he was so crucial to implement my engagement strategy for listed companies.
Yeah, that's fascinating. Darren, before I wrap up, I realize at the heart of what we're doing, I guess as one CEO to another, we've learned a lot of lessons. I've learned a lot of lessons since starting the firm. It sounds like you've learned a lot of lessons. When you look back on the last, say, 5 years, what would you tell yourself, or if you knew what you know now, give me one or two examples of what you would tell yourself, your younger self, before you started this venture?
Yeah, the most important lessons I got for last 5 years is that investment and investment business are very different. I worked as a portfolio manager more than 18 years in Korea. I performed very well. So that's the reason why I was the youngest CIO in Korea. So I think that investment business was not different with investment. It's just sort of making money, but doing business in investment industry is very hard, even for
For example,
investors.
yeah, what do you mean by that? Investment business is different from investing. Or you mean that running a business is different from investing in business?
So my advice would be to develop not just as an investor, but as a well-rounded business professional in the investment industry. So build expertise beyond the selecting and analyzing investment ideas and work on the broad skills needed to success in this field. That's my lessons.
Excellent. Well, Darren, thank you so much for your time, and it's been a real pleasure working with you. We're really excited about your new offshore fund, and we wish you all the success as you help Korea build its next stage of development.
Okay,